In this video, we're going to start our discussion on intangible assets. So remember, intangible assets are those plant assets that have no physical substance, meaning you can't touch them, but they're still an asset. So they are still assets that are expected to have a long-term benefit to a company. They just don't have physical substance. So they're also used, just like physical plant assets, in the operation of a business to generate income. And we value these intangible assets based on cost. So some common examples of intangible assets would be things like patents, trademarks, goodwill, even copyrights or franchises. So how do we distinguish between an operating expense and an intangible asset? So for an expenditure to qualify as an intangible asset, there has to be evidence that this expense, or this cost rather, is going to benefit us in the future, not just this accounting period. So if there's considerable evidence that future benefit will be reaped from a cost, then it won't be considered an operating expense, which is a revenue expenditure, but rather would be considered to be a capital expenditure, and it would be recorded as an intangible asset on the books. So, but if a company is uncertain, or if there isn't really evidence that an expenditure is going to yield future benefits in later years, a company will often opt to just record it as an operating expense instead. Now, these intangible assets also are essentially used up as time goes on, just like a physical asset. Physical plant assets, besides land, they are depreciated. There's depreciation expense. Intangible assets, they're not depreciated, but they're amortized instead. So there's amortization expense that's recorded. So amortization is very similar to depreciation, but it's a systematic write-off to expense of the cost of an intangible asset over its useful life, where when we systematically allocate a physical asset's cost to expense over its useful life, then it's depreciation. But if we're talking about an intangible asset, then it's called amortization. So usually the entry to record amortization expense would be a debit to amortization expense and a credit to the intangible asset account in question. So, and again, it's essentially the same as depreciation. So sometimes it's difficult to estimate the useful life of an intangible asset like a trademark. But a company has to make an estimate because it's unlikely that something like that will forever provide benefit. It will forever contribute to future earnings. So an estimate has to be made of a useful life. So because of this, the cost of the intangible asset will be allocated to expense over its useful life. So it will become part of that net income calculation at the end of a period. And usually for amortization, the straight line method is used. So in the video to come after this one, we'll look at the various different intangible assets in turn.